Good afternoon. Welcome everyone to the online Geneva Trade and Development Workshop, which is a seminar series jointly organized by the CEPR, the Geneva School of Economics and Management, the Graduate Institute Geneva, UNCTAD, and the WTO. For the seminar of today, I'm delighted to introduce Jean Grossman from Princeton University, who will present when tariffs disrupt global supply chains. The presentation will last 1 hour and will be followed by 15 minutes of questions and answers. During the presentation, please feel free to ask clarifying questions in the Q&A window. I will try to relay them to Jean with the help of my co-hosting colleagues. We are also very lucky today to have Elhanan Helpman, the co-author on this paper, with us. So without further ado, Jean, the floor is yours for an hour.
Thank you, Frederic, and thank you, everybody. I'm not sure I can repeat that entire list of participants, but we appreciate the opportunity. And as Frederic said, and as often the case, this is joint work with my longtime collaborator, Elhanan Helpman. So as you all know, 1 second here. As you all know, much of world trade is in intermediate goods these days, as much as 2/3 by the estimates of Johnson and Noguera. Some of these intermediate inputs are purchased on anonymous world markets for materials and raw materials and metals and so on. But many of these transactions take place within supply chains. So what is a supply chain? I feel like I hardly need to talk about this to this audience, but the World Development Report, the last World Development Report, has a very good chapter, actually written by Paul Antros, which describes the distinctive features of supply chains. First of all, they're made possible by the technological innovations of fragmentation that allow us to divide up production processes. They often involve non-trivial search costs as downstream producers look for upstream suppliers, and sometimes upstream suppliers look for downstream customers. Involved with that search is a requirement for matching of compatible partners, so not every pair of firms can work well together. Often they involve relationship-specific investments and customization, typically governed by incomplete contracts with frequent renegotiation, and they typically generate durable relationships, or what is sometimes called stickiness. So relative to simply treating intermediate inputs as another transaction in a competitive market, the global supply chains are much more relational and much more a meeting of a specific buyer and supplier. And as most of you also know, there's a burgeoning literature on supply chains, an exploding literature, large literature. It addresses all sorts of questions: who participates in supply chains, what's the geography of international sourcing, what are the implications of supply chains for market structure and productivity, what's the implications and reasons for the persistence of sparse firm-to-firm networks. What we don't see a lot of in the literature is discussion of trade policy in the context of global supply chains. And there's a good reason for that. Before 2018, as many have observed, trade barriers were notably escalated, meaning that tariffs on intermediate goods were much lower than tariffs on final goods. The further downstream, the higher the tariffs. So, for example, Chad Bown and Meredith Crowley estimate that tariffs on final goods are as much as 75% higher on average in the G20 countries than on intermediates. We did our own calculations for the US, and we found for the period 2010 to 2017 that the weighted average tariff on intermediate goods was only 0.9%, and therefore low enough to be mostly ignored in our analysis. But as you know, history changed course with the Trump administration because the Trump policies, the trade war with China, involved a preponderance of intermediate goods. Trump was trying to avoid political costs of damaging tariffs to his base and the goods they consumed. And so instead, they levied their tariffs in China mostly on intermediate goods, so that by September of 2018, 82% of intermediate goods imported from China were covered by the Trump tariffs, as compared to only 29% for consumer goods. By the time the phase one deal came in 2020, beginning of 2020, 93% of intermediates were covered by special tariffs concerning imports from China. Again, we did our own calculations for China, and this is what we found. The blue is the tariffs on intermediate, average tariffs or weighted tariffs on intermediate goods. The red is the weighted tariffs on final goods. And you can see that with the Trump tariffs, the tariffs on imports of intermediate goods from China jump from an average of about 3% to nearly 25%, about 24%. So the two features of this graph that we want to emphasize and talk about today is first the magnitude of that jump, a huge jump from 3 to 24. And second, our belief that very little of it was anticipated before 2017. That is to say, when the supply chain relationships were initially formed. So what happened? Well, we can look at this anecdotally. You can do Google searches of the business press. If you Google, supply chain disruption and Trump tariff, you'll find many hits. You'll find articles talking about how many firms were switching their supply chains from China to Vietnam or Thailand or Indonesia or Malaysia or other Asian countries mostly. Or you can find hits that talk about industries that were affected: electronics, furniture, hand luggage, auto parts, and others. Or you can you can find hits that refer to the firms that were undertaking the relocation of their supply chains, be it Samsonite, Cisco, Macy's, Ingersoll Rand, and many others. So a lot of anecdotal evidence that these Trump tariffs disrupted supply chains originally in China. Slightly less anecdotally, we applied the methodology that Mary Amity and Steve Redding and David Weinstein introduced for studying the Trump tariffs to look for evidence of disruption of supply chains in the trade data. So we looked at imports from China and imports from 13 other Asian low-cost countries as a reflection of the difference in tariff rates on tariffs imposed on China versus those other countries using HS10 data and product fixed effects using the monthly data that we got from Mary et al. For the period 2016 to 2019. This is hardly a last word on this subject, but it does scream out at you that a lot of dislocation took place, a lot of disruption took place, so that you can see that imports from China, as a function of the log difference in the tariff rates, fell dramatically, and there was indeed a rise in imports from these other countries. So this is sort of the motivating evidence we want to think about, is what happens when there's a large unanticipated tariff shock to intermediate goods on the relocation of supply chains. So then to wrap up the introduction, the goal of this paper is to develop a model of relational supply chains with many or all but one of the features emphasized in the World Development Report, and then use it to study the effects of unanticipated discriminatory tariff shocks on sourcing patterns, on prices, and ultimately on welfare. It will prove necessary, as we discovered along the way, to distinguish two sizes of tariffs. So I'm going to start talking about small tariffs, probably not the best description of the Trump tariffs, but small tariffs are ones that don't change the ideal location for searching for a partner. So if a small tariff comes along and a firm originally has a supply chain partner in China, the tariff is small enough and China is advantageous enough as a source that any new searches that take place also take place in China. If the firm decides to replace its suppliers, it will do so with a new one inside the same country. Large tariffs, probably more relevant to what's motivating us, is a case where the tariff is large enough that if a firm decides to replace one of its relational partners, it's not going to do it in China anymore. It's going to look in Vietnam or Malaysia or Thailand, or possibly it's going to look for a partner in the US and reshore those parts of the supply chain. There's lots of literature that I could mention, not lots, but some literature I could mention, but given the hour constraint, I'll just mention one particularly important vein, which is this work of Ornelas and Turner, and also Entras and Steger, which looks at hold-up problems in supply chain relationships and how trade policy can affect investments in customization. For the time being, we're going to set that to the side. So we're going to see ourselves as being very complementary to their work. We're going to emphasize the search and the renegotiation and the other features that I talked about that are mentioned in the World Development Report. But we're going to not going to introduce any kind of hold-up problems here. It's certainly on the agenda for us, or maybe for others, to combine the two, but I think there's enough to talk about without also introducing the customization and hold-up problems. So I'm at the end of slide 6. I was asked by the organizers to pause and take an opportunity for questions at various points, and this is one of them. Okay, I see a message, no questions. Let me plow on. Okay, I'd like to start before I dig into details of a model to just give a broad overview to get everybody onto the same page. It's a model that in many parts is going to be familiar to you, and then just a couple of new features that emphasize the aspects of supply chains we want to emphasize. So it's going to be a two-sector model. One in the background that's very boring, produces a homogeneous good under conditions of perfect competition with constant returns to scale. The action will be in the second sector, which produces differentiated products under monopolistic competition. All of that familiar from, say, the Venables model, which is similar to what we're going to build on here, except that in the production of these differentiated products, we're going to introduce relational supply chains. Okay, so in producing differentiated products, firms are going to combine a composite intermediate input that they're going to form through all their partners in their supply chain. They're going to combine that with labor, and we're going to assume that technology is Cobb-Douglas. The composite intermediate we're going to treat as a continuum of inputs used in fixed proportions. So you've got to get all of those parts of the supply chain undertaken for you, or possibly you can undertake them yourselves at a higher cost. That won't happen in the equilibrium we study. So you have to acquire this continuum of inputs from your various suppliers. And what the firms are going to do the downstream firms are going to do, the differentiated product producers are going to do, is search around and find a good source of each of those components of the intermediate, composite intermediate. And the action, the new parts are down here, search and bargaining. Okay, so we're going to assume that finding suppliers is costly. And so firms have to decide how intensively to engage in search or how to go about their search, paying a cost. When they find a potential supplier, they will learn whether it's a good match. They will learn a match-specific productivity, and then they face a decision. So knowing whether this supplier can reasonably supply them a component that they need for their composite intermediate, they can negotiate with that potential supplier, potentially come to an agreement, or go back to the search process and look for somebody better. So here's where search is costly and the intensity is endogenous. They decide whether to accept the first one that comes along or possibly look for a second. If they find a second, then they decide whether that's good enough or possibly look for a third, and so on and so forth. And our starting point, and then what I'm going to describe for you, is just a standard long-run monopolistically competitive equilibrium, which has zero profits in anticipation of free trade. So think of free trade as being the approximation to that 0.9% tariff on intermediates that we had in 2017. Okay, launching into a few of the details. Some of them, as I say, are quite familiar. We're going to assume that consumers consume the homogeneous good and the differentiated products with a quasi-linear utility function, linear in the homogeneous good, concave in the differentiated products. And the utility from consuming a basket of differentiated products has a constant elasticity epsilon. We're going to allow epsilon to be bigger than 1, less than 1, or even equal to 1, but constant. And then, as we're all familiar with, the composite final differentiated product bundle will comprise a CES aggregate of the individual differentiated products with an elasticity of substitution sigma, which we're going to assume is bigger than epsilon, as is commonly done. Okay, so all of this is standard. Production of the homogeneous good is just 1-for-1 with labor. Of course, that will pin down the wage rate in equilibrium. Production of the differentiated products, as I said, is Cobb-Douglas, combining labor and the composite intermediate input. And the way we'll express that is that the cost of producing the final good is a Cobb-Douglas function of the marginal cost of the composite intermediate and the marginal cost of labor, which, however, is 1, so you don't see it there. Okay, so this is just a standard exponential, with alpha less than 1 being the share of the intermediate goods. Okay, so let me spend just a few more seconds on the newer aspects of this. So you've got to procure all these different intermediates to form this composite. You need all of them in fixed proportions, and so firms look for suppliers. So we're going to assume that all the downstream firms are symmetric. So what one does, all of them do. And moreover, we're going to assume that the intermediate inputs are symmetric, in the sense that they take similar process of search and production in the source country. Ideally, this is going to give rise to a search process that involves identifying the best place to search. The slide says country A. I'll often fall into calling it China. So we identify China as the best place to search, and we look for all of our potential suppliers in China, at least in the free trade baseline situation. As a footnote or a comment, this is, of course, going to lead to one country supply chains. The entire supply chain is going to be located in China. So I guess it's global in the sense that it's not the home country, but it's not very global. It would be interesting to give different countries comparative advantage in different parts of the supply chain, and then we could have multi-country supply chains. But we've set that to the side here. So all of the search, the initial equilibrium, takes place in China. Okay, so how does it work? Well, the firm pays a cost, F, to send its procurers to China and look for a potential supplier for each of the continuum of different components. When it pays an F for one component, it'll take a draw from a Melitz-like distribution for that particular input that it's searching for. And of course, it'll repeat this many times for all the different inputs. So G, capital G, is the cumulative distribution of the productivities that the firm might get by finding a supplier in China. And as I said before, these are going to be match specific. So you can find a good supplier that's very compatible, or a less good supplier that's less compatible. So more specifically, we're going to parameterize in terms of the inverse match productivity, A. So G is a function of over A. And A tells us how much labor we need in China to produce a unit of the input omega, so that the cost of each input in China is W times A, where W is China's wage, and A is the inverse productivity. Okay, and G is going to give a range of possible realizations of A. And of course, if we're doing this for many different inputs, we're going to get many different A's with our initial searches. Okay, so a firm pays F, takes a draw, learns A, tells it whether it's a good match or bad match, and now it faces a decision point. It can negotiate a short-term contract with with the supplier at the unit cost WA, or it can say that that's not a very good match. We're going to go back, resume our search, and the firm can do that by paying F once again to find somebody else, and so on and so on. A key simplifying assumption, which buys us a lot in terms of tractability, but costs us a lot in terms of studying dynamics, is that we assume that these draws occur one after the other very quickly. Okay, so in some version of reality, a firm might find a supplier, think it's a mediocre match, start working with that supplier, but meanwhile, continue to look for another supplier, and then over time, it'll steadily improve its matches along many dimensions, and that would introduce interesting dynamics, both interesting but difficult to deal with, and so we set that to the side. So again, to repeat, this process of paying A, paying F, and drawing A's occurs with no real time being elapsed. Okay, so here's the search course that a firm pays. So what's the optimal strategy going to be? Well, as in all these kinds of search models, the optimal strategy is to set a reservation stopping level. If you find a good match, you stop. If you find a bad match, you continue. A bar is the marginal match that you're willing to accept, otherwise you go back. And of course, the firm chooses A bar. And if it chooses A bar, its total search cost will be, well, it pays F up front for that first draw. With probability G of A bar, it finds somebody that's good enough, that meets its criterion, and then it's done. And then there are no further search costs. With probability 1 minus G of A bar, it's back to the drawing board, and then it faces the search cost S of A bar again. And therefore, solving this simple linear equation gives us this very simple expression for the cost of search as a function of the stringency of search. The more demanding you are in your match, the more draws you're going to have to take on average, and therefore the higher are your search costs. So that's search. So now suppose we find somebody with productivity better than the reservation level, with A bar smaller than A bar, then we're going to bargain with them. So Nash bargaining with weights beta and 1 minus beta for the US firm and the Chinese supplier, respectively. There are lots and lots of these suppliers. So in order to achieve complete efficiency, what we'd like to do is bargain with them simultaneously. But there are lots and lots of them. In fact, a continuum of them. Even before pandemic times, it would be hard to get them all in the same room at the same time. Now we're not even allowed to do that. And so we assume that we bargain separately with each supplier, taking the bargains or the negotiations with all the other suppliers as given. Okay, or what is known sometimes as Nash and Nash bargaining. Nash bargaining with a Nash assumption about the resolution of all the other bargains besides this particular one that you're negotiating with. Since the inputs are needed in fixed proportion, once we take how much we're buying from everybody else is given, the amount that I have to buy from you as a potential supplier of one small input is the same that I've agreed to buy from everybody else. So in that sense, when the firms bargain with each supplier, they take the aggregate M, the amount of the component they're going to buy as given. Okay, Nash bargaining, we're going to bargain over a price, taking the quantity as given as a result of the Nash and Nash assumption. What are the outside options that against which this Nash bargaining takes place? Well, for the buyer, as I said, the option is to resume search and find somebody else. If you find somebody else, you pay an expected price, which I'm going to call mu for expected, rho for price, which is a function of how hard you're searching, how hard you're looking for a new supplier. And you're going to have to repay the search costs. So you get a new draw with an expected price mu rho at an expected flow cost F over G of A. And little f is the interest rate times big F, converting it into a flow. Okay, so that's the outside option for the buyer. The outside option for the supplier is simply not to make this particular supply relationship, and then it gets 0. Okay, so set up the Nash bargaining problem with weights beta and 1 minus beta, and solve and share the surplus as usual relative to these outside options. And we find that the cost of procuring a bundle M of all these inputs, which of course, because there's a continuum of them, we can use the law of large numbers, and it turns out to be what you see here. It's the expected value of A conditional on how stringent our search process is, times how many we're buying, times the wage in China, plus a fixed cost. A fixed cost incorporates both the fact that we have to pay for our search and the fact that our outside option, which is to resume search, invokes more fixed costs, and some of those get borne by the producer in the Nash bargain because they weaken his bargaining position since he has to pay to leave the negotiating table. Okay, so this is the total cost perceived by the downstream firm to procuring M. And of course, that total cost depends upon A bar, how stringent the search is. And I'll say more about this on the next slide. But before I do, let me just point out that this total cost of M bar has two components, a component that doesn't vary with quantity and a component that does vary with quantity. So this thing here is the marginal cost perceived by the firm of procuring a bundle of intermediates. And an important thing to notice that'll come back later when we talk about the welfare calculus is that this marginal cost is, of course, less than the average cost because there's a fixed component here as well. So the marginal cost that the firm sees in producing these inputs, which is this, is less than the average cost. Okay, so the firm faces an obvious trade-off. On the one hand, searching hard is expensive. On the other hand, searching hard finds better suppliers, which result in lower prices at the end of the day. And so that's the trade-off that the firm makes when choosing how strictly to search what its reservation price should be. Okay, and what you see here is that the weight on the cost savings term, of course, is proportional M times W. We call this the stake in the search outcome. If you're buying a lot, or if the Chinese wage is high and on average costs are higher, you want to search hard. If these are low, then you want to search less hard. Your stopping rule becomes more stringent the more stake the firm has in procuring these inputs. Okay, so the first order condition for this can be substituted back into the formula for the price that the firm's paying, and we get this very neat and intuitive solution for the negotiated price of an input with productivity A. It's a weighted average of the cost of producing A, the unit cost of producing that input with productivity A, and the unit cost of producing the least productive or the marginal match that you'd be willing to accept, which has productivity A bar. So if beta is 1, if all the bargaining weight is with the US firm, then the price is simply marginal cost. If beta is 0, then the firm has no bargaining power. The price is what it would pay with the worst match it would accept, and otherwise it's simply a weighted average in between. Okay, so without writing down all the general equilibrium conditions, because I think there's familiar zero profits and markup pricing and the like, and now using the search and bargaining to substitute for the cost of the inputs, we solve for this zero profit equilibrium, which is the starting point for our tariff analysis. We're going to introduce an ad valorem tariff on imports from country A. I'm actually going to talk in terms of tau, 1 plus the ad valorem tariff rate. And I'm going to assume that at the time all of this took place, it was completely unanticipated, which means the number of firms that entered the industry was predetermined in expectation of tau equal to 1. This is my second breaking point, so let me stop and ask Frederic if there are any questions he wants to to ask?
There were two questions, but two answers also from your co-author. So there is an interesting conversation going on between Julia and Elhanan. But maybe in the interest of time, I suggest we go back to that conversation in the Q&A time after you talk. If that
sounds good.
Yeah, okay, thanks.
Sounds good. Okay, so just as a roadmap for what's coming, as I said, we're going to talk about small tariffs and large tariffs. A small tariff is a tariff such that the tariff inclusive cost of sourcing in China is still less than the non-tariff cost of searching in the next best place, which is, say, Vietnam or the US. And so any new searches that take place after the tariffs are introduced are still best done in China. And a large tariff is the opposite. We also need to distinguish the case of elastic demand when epsilon's bigger than 1 from inelastic demand when epsilon's less than 1. And just to tell you what's going to happen so you can keep it in the back of your mind. If we're in the elastic case, we have a small tariff at the end of the day. Although the firms could search for better suppliers, they will do so in China. It never pays for them to do so. They always renegotiate with their original supplier and thereby avoid extra new search costs. Even if the tariff is large, if it's large in a range, if it's only a little bit large, if you will, there's a range where it still pays for them to renegotiate with their original suppliers against the backdrop now of looking in Vietnam, but they actually never go to Vietnam. They still continue to renegotiate with their original suppliers. There's no incentive for new entry here, so the N original firms continue to produce and they renegotiate their original suppliers, of course, ending up potentially with different prices than we had originally. For still larger tariffs, they're going to start to replace parts of their supply chain, of course, beginning with their least productive matches and going down to more and more productive matches as the tariff gets bigger. And when they do so, they're always going to look in Vietnam or they're going to reshore to the US, the next best country B. We'll find that in the inelastic case, for small tariffs, again, the original firms retain all their suppliers and renegotiate with them. Now, surprisingly, the tariff induces entry, and there are new firms, and new firms also find suppliers in China. The inelastic demand will make it profitable to enter, despite the fact that the tariff is raising costs. And I'll discuss that. For larger tariffs, the supply chains are going to start to shift to Vietnam. So this is the empirically relevant range, if you will, for the Trump tariffs. The new entrants find suppliers in Vietnam, and the old entrants, the original entrants, replace their suppliers in Vietnam. Okay, so let's start with a small tariff and begin with renegotiation. As I said, the actual searches, if any take place, they won't, but if they were, they would be in China. The important thing is the new searches that are threatened in the course of the Nash negotiation, renegotiation, also are in China. And so the renegotiated price is against a backdrop of an outside option. It involves searching in China with the new stopping rule. And the new price is a weighted average of the marginal cost of the actual producer and the marginal cost of the least acceptable alternative producer. So to the extent that the search incentives changing how stringent you'll be in your searches, the price that you pay to your actual suppliers, your original suppliers, will change as well. Okay. And as the last bullet point says, These are terms of trade effects that we don't usually think about. They come about as a result of negotiations under altered conditions. Even if you stick with your original supplier, the amount that the firm pays for that supplier is going to change. So which way is it going to change? Well, as this makes clear, if the threatened search becomes more intense, stricter, that improves the bargaining position of the downstream firm and the price it pays falls. If the threatened searches become less intense, it has less incentive to search, less discerning, as I say, then the terms of trade deteriorate. But we saw already that the intensity of search depends upon the stake that the firm has in the search process, how much it wants to buy, and what inclusive price it's going to pay. So if the tariff inclusive price of the bundle it now wants to buy is less than the original quantity, then it has a smaller stake in the search, it searches less intensively, and its terms of trade deteriorate. On the other hand, if its stake in the search rises because tau times m goes up, then it's going to search more intensely, and its terms of trade the country's terms of trade are going to improve. It's going to get better prices. And this stake turns out to hinge exactly on the elasticity of demand. This remains the same in the Cobb-Douglas case with epsilon equal to 1. Otherwise, if epsilon's bigger than 1, the stake falls, terms of trade deteriorate. If this is greater than m, as it will be when epsilon's less than 1, then the terms of trade improve. Okay, so that's exactly why we have to distinguish these two cases, that together with the fact that the entry will be different. Okay, when epsilon is bigger than 1, as I just said, the optimal stopping rule under the tariff is less stringent than the optimal stopping rule under free trade, which means that all of its original suppliers already satisfy its reservation level of productivity, which means it has no unilateral incentive to replace them and find somebody new. So that's the basis of the statement that no new searches take place in the case of a small tariff when epsilon is bigger than 1. Of course, there are threats to go look. Those threats have become less credible, and therefore the firm is going to pay more to its original suppliers in this case. But it's going to keep them at the end of the day. When epsilon is less than 1, the incentive to search become more intense. So that's going to tend to make the firm get a better deal on its prices. However, the fact that the elasticity of substitution is less than 1 implies that the increase in the price index is very powerful. The downstream firms face a profit hit from the tariff they have to pay, but they benefit from the fact that their competition is also facing those tariffs. And when epsilon's less than 1, that second effect dominates, which raises profitability in this industry, makes the industry more collusive, if you will, and therefore induces new entry. That new entry, in turn, reduces the stake of the original producers in searching harder. So at the original level of entry, they would want to search more intensively, but by the time entry all settles, they don't search anymore intensely. They search exactly as intensely as an original equilibrium, which means, again, none of them replace their original suppliers. We just get a bunch of new suppliers who search exactly like the original guys did. So very different outcomes depending upon the elasticity of demand for the differentiated products as a group. Okay. So that tells you what happens to sourcing patterns, namely not very much. They all keep their original suppliers. Tells you what happens to prices. In the elastic case, the price of the inputs go up. That gets passed on to consumers in the usual way with markup pricing. And so the last thing I want to talk about is welfare. Since there are no new searches, there are no new search costs. Since there's no entry in the elastic case, there's no new entry costs. So there are no new fixed costs in this case. The tariffs that are paid are a direct transfer from the producers to the government. So that's a wash. So the parts of welfare that can potentially change here are the utility of the consumers from consuming a different bundle of differentiated products, less the opportunity cost of the inputs into producing, which is the number of firms times the average price we pay per input times the amount of imports we take. This is the total cost of the total tariff exclusive cost of the bundle intermediate inputs, the real cost of those inputs. The tariff part is just a transfer to the government, as I said. And then this is the cost of the labor, which is an opportunity cost because the labor could otherwise be used to produce the homogeneous good. So remember, we're going to look at a large, or in this case, small but finite change in the tariff. So we're not going to be looking at marginal changes in the tariff, but the way I'm going to understand the welfare effects is to take this derivative, that how welfare changes with the size of the tariff, and then integrate it up over all the inframarginal tariffs up to the tariff level. So there are three terms I want to talk about. They come from here and here. There's an induced change in employment in the industry. There's an induced change in intermediate use in the industry, and there's an induced change in the terms of trade. Starting with that last one, because we already know the answer here. In the elastic case, the terms of trade deteriorate. And so the terms of trade deterioration is an immediate hit on the US welfare. To the extent that we're paying more to our Chinese suppliers for inputs, we're taking a hit on welfare. I'll come back to that. As for the change in labor, which way is labor going to go? Well, the firms are going to produce less, therefore use less labor. Is that good or bad? Well, these goods are being marked up relative to the homogeneous good. There's a distortion in the market for the differentiated product due to monopoly pricing. And so the fall in employment exerts a negative effect on welfare because we're producing too few of these differentiated products. And this is familiar from Dingra and Morrow and lots of other places. The fact that we have a homogeneous good competitively produced and a differentiated products monopolistically competitively produced means we're underproducing to the extent that the tariff inflicts a hit on production. There's a welfare cost. This last one is more interesting or new, more interesting because it's new. So first of all, you see the same. So let me start with a different first of all. First of all, input uses of the intermediates is going to go down, both because the industry is shrinking with these higher costs and because the firm substitutes away from intermediates that are now more expensive. So intermediate usage goes down. Is that a good thing or a bad thing? Well, you see the sigma over sigma minus 1, we're underproducing differentiated products. So that effect would tell us we want to produce more of them, which means that's a bad thing. On the other hand, when the firm is making its choice between labor and intermediates, it's using a perceived marginal cost at the end of the bargaining process of fee. It's acting as if on the margin it's paying fee. The true total cost to the economy of importing intermediates is rho. Fee is less than rho. I asked you to remember that marginal cost is less than average cost. And so this term can be bigger or smaller than this term. In other words, the welfare effects of this one term here of shrinking demand for composite intermediates are ambiguous depending upon sigma and depending upon the gap between phi and rho. Okay, quickly moving on. Now let's look at large tariffs. Large tariffs are going to induce any new entrants to search in Vietnam instead of in China. And in the bargaining, and if the original suppliers switch sources, they're going to go to Vietnam. If they don't switch sources, they're going to renegotiate against a backdrop not of finding a new supplier in China, but rather of finding a new supplier in Vietnam. So all searches, actual and hypothetical, or those that play a role in the renegotiation, are now taking place in the low-cost country B. And I say Vietnam, but as I mentioned, it could also be reshoring. The evidence is that not much of this happened in response to the Trump tariffs, but in principle, it might have. That was certainly the objective of the tariffs. Okay, the upshot of the fact that the new searches that are threatened will take place in country B is that the supplier will have to bear some of the burden of the tariff. If you work out the Nash bargain now against an alternative option of sourcing in Vietnam, now you'll see that part of the burden of the tariff is borne by the Chinese supplier when they renegotiate. So how does this square with Amity et al. Finding that the US paid the tariff and not the Chinese? Well, if you look closely at their 2020 paper, you can see that that's strikingly true for final goods, where the pass-through was 1-for-1. But if you look at their charts for the intermediate goods, you in fact find that the burden of the tariff was shared in those cases by the Chinese suppliers. So in fact, what we're finding here, which is that China will pay part of the tariff for intermediate goods, borne out by this evidence. In this case, we have a terms of trade improvement. So a tariff that harmed the terms of trade, on the margin, we get a terms of trade improvement. I'll come back to that on the next slide, so keep that thought in mind. For the case of an elasticity bigger than 1, there's no new entry. The original suppliers renegotiate with the suppliers they keep and potentially search for new ones. What we find is if the tariff is less than some critical level, they renegotiate with everybody and don't find any new ones. If the tariff is bigger than that critical level, they renegotiate with everybody they keep while replacing a range of the least productive suppliers. If epsilon's less than 1, as I said, new entry takes place, everybody searches in Vietnam, and the original suppliers replace their least productive suppliers in Vietnam, which is another source of terms of trade deterioration. Namely, to the extent that we replace low-cost suppliers in China with high-cost suppliers in Vietnam, we get binarian trade diversion. Okay, so I'll use my last 6 minutes to show you some graphs, how this all works out. So first, the terms of trade change. This was the last thing we were expecting when we started this project, but we now understand. So here's a a favorite set of parameters, elasticity of substitution of differentiated products of 5, a Pareto distribution of productivities with the usual parameter 4, an elasticity of demand for differentiated goods of 1.5. So this is the case with epsilon bigger than 1. Half and half use of labor and intermediates in the Cobb-Douglas, half and half bargaining weights between the supplier and the downstream firm, a Chinese wage, half of the US wage, and a Vietnamese wage, 60% of the US wage. So here are the small tariffs with these numbers. The cutoff for small versus large tariffs is 1.2. We said a bigger tariff means less bargaining power for the downstream firm, therefore higher prices. So you tell me the tariff, 10%. I tell you the negotiated average price, and the bigger the tariff, the worse the terms of trade turn out to be. In this range, between 1.2 and the critical cutoff point, no suppliers are replaced. We just get renegotiation with everybody. And the fact that we're shifting the tariff burden onto the Chinese means the terms of trade improvement that get us all the way back down to a better terms of trade than we would have had under free trade. So small tariffs harm our terms of trade. Tariffs in this range can potentially improve our terms of trade. At this point here, we start to replace our suppliers. So we get an extra kick from Viner. For a while, the larger tariffs still generated better terms of trade, but ultimately, once we're replacing more and more, we're paying higher real costs for our inputs, and the terms of trade deteriorate. So remember, the welfare effects are ambiguous, but for these parameters, and those around them, they're quite clear. The tariff is harmful if it's small. In this little range here between the large tariff and the critical tariff, it's not quite as bad, but still a lot worse than 0. So the tariff is still harmful, a little less so. And then once we start to switch our suppliers, the bigger tariffs hurt us even more. So here's the Trump tariffs, about 25%. And by these kind of standard parameter values, they're costing us about a 3% of industry expenditure welfare cost as a result of terms of trade deterioration, plus the shrinkage in the size of the differentiated products sector. So bottom line from this picture is that although the welfare analysis is ambiguous, reasonable parameter values and even somewhat unreasonable parameter values, we always found welfare losses from the Trump tariffs. If we're talking about an industry with an elasticity of demand of 0.5, less than 1, and all the other parameters are the same, welfare is very flat over the range of small tariffs. If I blew this up many times, you would find that it's in fact slightly inverse U-shaped, which is to say there's an optimum second best tariff, bigger than 0, somewhere in here. But it generates almost no welfare gain, a trivial amount of welfare gain, because this is so flat. Once we get into large tariffs that induce Vietnam to become a serious alternative, welfare again falls off a cliff. And so for a 25% tariff, in this case, we get about a 1.5% welfare loss, and even bigger for larger tariffs. Are tariffs ever good? Well, we thought it was our obligation to to find you an example where the tariffs for welfare are improving. I don't know why. Mostly my co-author thought that that was our obligation. So here they are, tariffs that are welfare improving. In the case where country B is Vietnam, tariffs are rising. But what have I done before I say that? I made the elasticity of demand even smaller, 0.3. And I gave the Chinese suppliers a lot of bargaining power, 7/10 of the bargain in the Nash renegotiation. So that combination, and I made them, well, let me stop there. So now the cutoff for small and large tariffs is over here, 1/0.9. Tariff welfare is rising over a range of small tariffs and rising further over a range of large tariffs up to about 1.2. And then the Vinerian trade diversion kicks in, and we have welfare losses for quite large tariffs. But we do have, in this case, an optimum second best tariff of about, I don't know, 17%, bigger than the critical level for a large tariff that does generate a welfare improvement. Now, part of the reason why tariffs are not great here is because they're changing our terms of trade. We're paying the Chinese original suppliers, and we're paying the Vietnamese when we replace them. What if it's not Vietnam? What if it's the US? What if we're reshoring? What if the next best alternative is to bring the production home? Well, that's what you see in the dotted line. In this case, bringing production home is profit shifting. It's taking those profits away from Vietnamese and Chinese producers and putting them in the hands of American suppliers. From an American welfare point of view, that's beneficial. And so you can see, in this case, with these stream parameters and the US as the next best alternative, now we can start to get substantial welfare gains. So let me wrap up. We've talked about some new mechanisms for tariffs to affect prices and welfare. There are renegotiations in the shadow of renewed search. Input prices will change depending upon whether the incentives for search intensify or mitigate. If they intensify, then we get better terms of trade, better prices on our inputs. If they mitigate, as is the more typical case, and certainly when epsilon is bigger than 1, then we will pay more for our inputs, much as Amity et al. Found. The bargaining drives a wedge between the marginal costs that the downstream firm uses in deciding its production techniques and the true resource cost of the intermediate inputs, which adds a new distortion that will be affected by the tariffs. That actually points in favor of a second best role for tariffs, but in most cases doesn't get large enough to offset the ones that we already knew about and understood from before. Last point, large tariffs generate Vinerian trade diversion. If we look for them in the data, where are they going to show up? They actually show up in the cost that the American firms bear to do new searches in Vietnam. That's where we end up paying more for our inputs. We're doing new searches that could have been avoided or would have been avoided absent the tariffs. So I point this out for those who want to measure the cost of tariff. This is not necessarily a place where you would look for welfare costs of tariffs, but these are real costs borne by the American firm and by the US welfare of finding a new set of trade partners. Also, if we were to do customization, there would be costs of new investments in customization that would be in this same category of hidden costs of welfare. What's missing? I think I mentioned these things already, but I'll just emphasize them. Heterogeneous suppliers would be interesting because they could give us multi-country sourcing. Here, China is the best place to search for everything initially, and Vietnam is the best place ex post. With heterogeneous suppliers, that wouldn't necessarily be the case. We bought a lot by collapsing the search process down into a tenth of a second. But if there were real time involved in search, and especially renewed search, then there would be slow adjustment. I think that would be really interesting. I think it would involve computer simulations. I don't think there's going to be much prospect for analytical progress on this, but that could be interesting. And then finally, we've ignored all the customization aspects associated with investment in the relationship. Those are studied by Ornelas and Turner, Antros and Steger. They could be reintroduced here on top of the search process, and maybe there would be some interesting interactions between the two, but we haven't done it yet. Okay, so that's reasonably within my time limit, so there you go.
Absolutely, thank you very much, Dean. We have some questions in the Q&A. So the first question is by Oliver Braunschweig. So Oliver, if you could please unmute yourself and ask your question to Jean directly. He seems to be trying to connect, but yeah, here we go.
Hello, can you hear me now?
Sure can.
Wonderful, thank you. Thank you very much for this very interesting presentation. My question is specifically for what you're describing on slide 16 and the welfare effect. And I want to ask, to assess a fuller welfare effect, shouldn't we include a term about the possible effects of policies which the taxes might fund? We could, of course, say government expenditure might in any way be bad or good or something mixed. So similar to what you're doing with other things, it seems to me currently the assumption in here is that any tax revenue goes to waste. There's nothing that happens with it in terms of welfare. Thank you.
Sure. So that's the last. I was with you until that last sentence. We are not assuming that the tariff revenue goes to waste. We assume that it gets redistributed to consumers. That's why we count the tariff revenue as a benefit. It's a cost to the firms. It's a benefit to the government while it holds it, and then to the consumers once they get it back. At least that's our assumption here. If the projects that it would fund are worth more than $1 on the margin, then that would be a welfare benefit that the government could use those revenues more productively than handing them back to consumers. That would add an extra welfare benefit. On the other hand, if the marginal product was worth less than $1, then that would be an additional cost of spending on bridges to nowhere instead of giving back to consumers. The neutral assumption, it seems, would be that the projects or the redistribution is worth one for one the money that's raised, which is in fact what we've assumed.
Thank you.
Sure.
Thank you. We have a question from Manish Sharma. Manish, please.
Hi. Thank you, sir. I just wanted to ask, service trade is continuously increasing globally. So just wanted to know what would be the optimum strategy in terms of tariff to benefit for the service trades.
So I guess the question is how services are different than goods. We're agnostic here whether the components of this composite intermediate good are a bundle of literally components and parts, like would be input into say, a Boeing aircraft where they source all over the world for their parts, or whether parts of this supply chain are costs of marketing and costs of services like that, in which case we could consider them part of our bundling. So the cheapest and not very helpful answer to your question is, this model can incorporate services as long as services look like intermediate goods. To the extent that they're different, and the reason why it's slow and to study service trade is because it seems like every service is different. It's very hard to describe a canonical service and a canonical service trade. Some of them can be done through the internet. Some of them have to be supplied by somebody flying from one country to another. And so I think we'd need a very different model of the production structure to get any real serious answer. And I think the answer to your question would involve different answers for different types of services. Since I haven't done it, or we haven't done it, I can't really answer the question in a more concrete way than that. However, let me just one parting thought, which is I think these renegotiation aspects are going to be equally relevant there. If you break up with your supplier of a service, a call center, say, then you've got to arrange for a new relationship, and that's going to involve new search. And the fact that that's going to be affected by a tariff, or your incentive to do so is going to be affected by a tariff, is going to generate the kind of renegotiation we talk about here in any model of service trade.
Thank you. So you are assuming a constant elasticity of substitution, so it buys a lot of tractability, but I'm sure that Monica would like to interject on that. Maybe. Monica?
Yeah, no, thank you again, Jean, for the very clear, super clear presentation. I was wondering, so lots of your results hinge on the constant elasticity of substitution, so much so that you categorize your results by the values of epsilon, for what happens for when epsilon is greater than 1, what happens when it's smaller than 1. So I was just wondering how things would change if you allowed for a demand with a variable elasticity. What would be kind of affected in your model?
So I guess my answer to that is stay tuned. The project that we're working on now is actually about uncertainty and disruptions in supply chains, of course, stimulated by the pandemic, but not only by that. And we found in studying that as you predict, the constancy, the elasticity of the substitution is very important to the results, because we're familiar with the Dhingra and Morrow results and others that say that in the CES case, two effects just happen to balance, so that the profit stealing effect, the incentive firms have to undertake investments in lower costs to steal customers from their rivals, just balances against the direct cost effects, and that's a knife edge case. So in our current work, we're borrowing from some work by Kiminori Matsuyama and a co-author, and we're using homothetic demands with a single aggregator, is what he calls them. And we're doing the welfare analysis with those demands. And it does make a difference. And it makes a difference whether Marshall's second law applies or not. I think you know that as well. And so, yes, you will get slightly different welfare results. I mean, a cheap answer is if they're not too far from CES, then you won't get very different results. So you really need the elasticity to change significantly in order to overturn these kinds of results. But I guess if anything's going to do it, a 25% tariff probably will generate some significant changes.
Yeah, thank you very much.
Thank you. So we are running over time, but I would like to take one more question from the floor. Giacomo Poncedo, can you ask your question, please?
Thank you. Hi, Jean. Yes, so my question is, the intuition I got from the seminar is mostly that you have all these new effects from search frictions. Now, of course, that's not the only thing there is in the model, but I was wondering, probably there are search frictions in the search for final goods too. So I was wondering, if you put search frictions in final goods, how many of your results will apply also to tariffs on final goods and show that even tariffs on final goods are even worse than classical frictionless models make them seem?
That's a great question, not one that I've thought through, but what you say sounds very plausible. And I mean, I think these terms of trade effects of renegotiation, say between Walmart importing, completed shirts from China, might be rather somewhat similar. So I'm just going to agree with you. That's plausible and probably something that certainly in measurement we might want to take into account.
Thank you very much. So sorry, we don't have time for further questions. So what I would suggest is that if you have some pending questions you would like to ask to Jean and Elhanan, please feel free to drop them an email. So thank you very much, Jean. So thanks for being with us today, and thanks also to the participants. So I would like just to add that the next seminar will take place on the 10th of May, and the speaker will be Paula Conconi from Brussels. So thanks again to Jean and to Elhanan for being with us today, and thanks a lot for this great paper and this great presentation.
Thank you. Thank everybody.
Thank you. Bye-bye.
Bye-bye.
Bye-bye.